And welcome back to WealthWise. It's me, your host, Jordan Kimmel, and we are with Senior José Torres, the senior economist over at Interactive Broker. You see him everywhere. We're happy to have him. And Jose, thanks so much for joining us.
Hi, Jordan. Always a pleasure. Hello, ladies and gentlemen.
Yeah. So what's interesting right now is I believe maybe we could take the Fed and give them a little backdoor, let them kind of rest a little bit. We kind of know what they're doing. I think the really interesting information going on is a new administration coming on with some new personnel. The market seems to love the new Treasury pick. I think we'll get a new Fed pick. Give us a backdrop to what you see going on with the new administration and most of all, the market of the bond market and interest rates.
Great, great. So a lot to unpack there as usual. So let's start off with Besant. Treasury yields gave a huge thumbs up to Besant. Seemed like a balanced pick. Besant is expected to manage tail risk, keep financial markets in control. So folks really looked favorable on him, especially with his financial experience, hedge fund investment management experience. Tilting over to the SEC, here's where the retail frenzy really picked up, accelerated with the pick Atkins, who happens to be a cryptocurrency aficionado, sent essentially President-elect Trump, by choosing Atkins, sent Bitcoin up to roughly 105,000, a new
Right.
record. um, and of
Amazing.
course, and of course, all the other coins, the alternative coins that we don't talk much about in the mainstream, but folks, um, like to engage in here and there. Those coins, a lot of them have also been increasing. The speculative manias, as far as the Department of Government Efficiency, you're going to have a lot of changes in government. There's a lot of fat in a lot of these departments. I worked in the government for 6 years, more of a markets kind of person within the government. We have to wait and see because Ramaswamy and Elon Musk are austerity guys. They want to cut, but President Trump isn't necessarily a fiscal hawk, right? He likes to give the goodies. He's a crowd pleaser.
Get the
He
liquidity going, right?
He wants to get the liquidity going. He does not want to touch Social Security and Medicare. Those are a
Right.
lot of those people in that cohort voted him in. Back in during 1.0, he didn't want to have the conversation, and unfortunately, Jordan, those are the elephants in the room when it comes to balanced budgets and those kinds of things. Now, Elon Musk has done magical things in the past. We saw it with Tesla, we saw it with SpaceX, we saw it with PayPal, among other activities that he's engaged in. So the fact that we have top talent at this juncture trying to solve the most complex problems that we have, I think that's a plus.
Right. No, I think it's a gigantic plus. He came out today. I actually read a little quote by talking about just the inefficiencies in the computers of the government that they really are not even able to check for fraud and double payments and this and that. There's a big opportunity there. Let me get political with you for 1 second. I saw a trial balloon. I don't know who said it, but they talked about eliminating or at least drastically reducing the amount of foreign aid we give. And that's a big number. I don't know what that number is, but I'd have to think if we were to really cut back dramatically on foreign aid, if it's possible, maybe it's not. Um, that's another area to look at, no?
I think so, especially when we're looking to cut spending. Obviously, we want to keep our geopolitical stance tough, but at the same time, we need to take care of a lot of the problems that we have at home. We have bifurcated consumers, bifurcated households. On the one side, we have folks that have several investment portfolios, a few 401ks, a few houses. They're doing great. Since COVID, those assets appreciated significantly. Now, when you look at the other side, you have the American household that's struggling to manage the stresses of elevated cost, high interest rates,
Mm,
and reduced credit availability. And their primary source of income and wealth is a job, is a paycheck, right?
right. Yeah.
So we need to take care of those folks. We need to take care of our veterans that fought in battle and stuff, and a lot of them here, aren't having prosperous economic fortunes, right? So we have a
Yeah.
lot of problems at home. Last thing I'll say about this, Jordan, is the home affordability situation, right? Let's solve some of those problems. Maybe we have a huge defense budget, right? Just, I mean, this is just off the top, right? How about we bring a lot of those soldiers, bring them here, and
Oh
have them
man.
start building houses?
You know what? Do we really need 60,000 troops in Japan and 40,000 troops in Germany? I'm not sure we do. That's something for some smarter people to talk about. But I want to actually, being your role that you played in the government, and I'm not sure if this is out of your sphere, but we talk about this unsustainable debt, and that's one, I'm going to say that's one part of the balance sheet. There's another part of the balance sheet. And I know that there's something called, I think, the Bureau of Land Management, which periodically sells off some land to real estate development areas. Clearly, Yosemite and national parks are off the table. But I looked up, what is the value of the real estate held by the United States? And the number that came up at a chat was $23 trillion. I'm not sure if that's an accurate number, but there's a tremendous amount of assets. And one of the things on the balance sheet on the asset side, with all the debt we have from the bonds, the government owns a lot of these bonds. And I want to just talk about, this unsustainable debt problem that hasn't really broken our bank yet. Are we really hearing enough about the asset side of this tremendously asset rich country?
I agree that the government situation in terms of debt, fiscal matters is unsustainable. And really, it's the interest expense.
Right.
It's comprising a larger and larger share of the budget. So if we don't implement cuts soon, s- it's going to keep increasing 40%, 50%, 60%. And then all of a sudden, we're in a situation that we can't resolve. We can't solve the problems. And then we become like Japan, where
Mm,
they don't have enough lenders to supply Japan with their sovereign issues. So they end up calling the Bank of Japan, which owns roughly half of the bonds outstanding. Here
right.
in the US, the Fed owns roughly, last I checked, maybe 22%, 21%,
Okay.
between a fifth and a quarter. I know during the pandemic at its heights, it went to a quarter, but they've been reducing their ownership of treasury assets as part of their quantitative tightening
Right.
program.
Right.
So if we don't solve the government problems, the debt problems, that's what's going to happen. The Fed is going to be forced to essentially purchase all the bonds and increase their ownership, and then quality of life, home ownership, inflation,
Mm.
those things will get worse.
Right. No, it's a great point, and again, the thought is you grow your way out of the debt, and that's just inflationary, and it's great for asset owners. It's not great for lenders. It erodes their dollar. I want to bring out now something else, and I bring this out because uh, I was just on a family vacation where I was with all kinds of cousins, and the conversation was basically that if AI really does what it might be able to do, how many people is it going to put out of work? And I want to now talk about old indicators that need to be retired, and then I'm going to see if you have any new indicators that you like. But we hear about every month is this big drum roll about the non-farm payroll number. And I'm asking how many people work on the farm? Maybe we need a new name for that. Or maybe we need to measure something a little bit differently. But we went from farming to manufacturing to information, and all the hype that the country would be doomed when these jobs left never really materialized. So maybe we need a new name for the non-farm payrolls. But what I'm asking you is that sometimes we're looking at old indicators that don't really work with the new economy. And I know how much research and how much things you do. Are there any things maybe that you combine when you look at things to create what I'm going to call the Jose Torres indicators that people don't really have a handle on yet?
Absolutely. And I would say that the Jose Torres indicator is essentially a buffet table, and it's long and it has all kinds of different pastries as well as entrees and appetizers. And there's
Mm.
and there's waitresses and waiters that'll also bring you some delicious drinks as well. So, what's on the buffet table? The buffet table, since you mentioned the employment indicator, comprises roughly the first 10 days of data on the calendar.
Mhm.
And we get some important data points from ISM manufacturing, ISM services. Those data indicators are pivotal to understand for the labor market health. And then comes the JOLTS, which tells us job openings and quits. On top of the
Mm.
JOLTS, I look at I look at Indeed job openings because
Mhm.
that's more real time. It's updated daily and it correlates well with JOLTS. So, what are all these signals telling me? Then we're going to look at ADP employment. They pretty powerful, Jordan. They most companies in the US, I want to say half of the employees that work in the US on W2s go through ADP.
Wow.
Those are some good numbers.
That's pretty good stock though. And
Yeah. And the
what's it
BLS,
telling you? I mean, so let me get to one of my questions here. So we went through this pandemic, 10 million jobs were closed, 10 million jobs are reopened. There's more and more automation going on. When you look at the jobs numbers, dig a little deeper for us. Like, so maybe you look at all of them, but you somehow create either a ratio or comparison of them. And what are they telling you, if anything, about not what's going to happen 5 years from now, but what's happening right now?
well, let me connect it to the government debt situation.
Okay.
Most of the jobs being created are non cyclical jobs. These are
Mm,
education,
okay.
healthcare, government, three sectors that are heavily influenced by fiscal stimulus. So, not necessarily by economic strength, just by money that the government is spending. Now, the cyclical industries, manufacturing, construction, professional business services, finance, leisure and hospitality, even those sectors aren't hiring that much.
Mm,
But there's been a lift in business sentiment following the election. There's been uncertainty that's been swept under the rug now that employers feel that the policies that are incoming are business friendly, fostering an environment where they can add employees in order to expand their operations, right? So I'm looking for that to start to take hold. But right now, that's what we're seeing. Cyclical industries aren't hiring much. Non cyclicals are making up roughly half of the job gains. Unemployment rate still low, ticking
hmm.
higher. Here's an
Okay.
important one: labor force is going up. Labor force going up, sorry, labor force going down. We have to keep watching that because if the labor force goes down, that puts upward pressure on the unemployment rate. Why is that important? Because the immigration policies of the incoming administration may lead to folks leaving the country. Self
Okay.
deportations, scared of enforcement actions. So if the
Okay.
labor force goes down, so unemployment rate, let's say 4% for simplicity, 4 million people unemployed, 100 million people in the labor force. If your denominator goes from 100 down to 95, now your unemployment rate, even though you only have 4 million people unemployed, still that hasn't changed. Now your unemployment rate went from 4% up towards 4.5%, right? So
Right.
that's the trend we have to watch: the labor force leaving. It's inflationary on the wage front because that means you have less workers to choose from. You got to pay domestic oriented workers that have been here longer. You probably got to pay them more. However, it's disinflationary on the housing side, right? So we're going to kind of see the push and pull on housing versus wages in terms of the whole immigrant situation, which by the way, we can pretty much guess based on last time that the immigration numbers are going to fall precipitously, but we're not really sure. We're not 100% sure. We don't know what other trends are going to occur. Remember too, immigration also caught a big headwind in 2020 because of COVID. So,
Right. Right.
those are some interesting things to watch. I would say final point here before we move on: Job market staying strong. I'm expecting hiring to begin to accelerate because of the uncertainty from the election swept under the rug. Watch the labor force due to immigration. And those are my insights for now.
Right. Well, I think that's tremendous. And you know what I always ask, because as long as things don't break and as long as the economy is still going and you know people are working, um, I'm more interested in the stock market, but it's supported by the economic, you know, conditions. So I guess what I'm going to always ask you to either reach out to us or share now, is there anything when you look around the corner that people are really not talking about? People are so caught up in the minute, you know, Jose, that they don't really think 3, 6 months down the road, but that's what drives the stock market. Is there anything you're seeing a fly in the ointment, or you think it's kind of in gear and the economy doesn't really worry you right now, and the new administration will adapt? Are you nervous about anything in particular?
The number one thing I'm nervous about, I'm hoping that the tariff policy, which I believe we need to an extent,
Hmm.
I'm hoping that it doesn't produce inflationary pressures domestically. I'm hoping that the structural benefits of the tariffs, I'm hoping that China acquiesces to President-elect
Hmm.
Trump's demands, and we can continue to grow in a non-inflationary manner. However, since the Fed's overreach on September 18th, when they
Hmm.
cut 50 basis points, we have seen a resurgence in inflation, particularly in
Right.
goods. Uh, CPI went down to 2.5% tomorrow, October 11th, 8:30 a.m. Eastern time, expected to go up to 2.7%. So the
Right. Right.
annualized figures are starting to move higher. Goods and commodities have driven the entire disinflationary train. It was never services that cooled off. It was never labor markets that cooled off. It was goods and it was commodities. Commodities, they're under control. Price of oil is below 70, but when you look at goods, now that's the threat, particularly with tariffs, particularly with lower interest rates. You know, the automobile dealerships can push more volume, the durable goods folks can also push more transactions, right? That's happening while at the same time you have the supply issues with the tariffs. So that could mean that the CPI moves back into a three handle, keeping the Fed on pause. And then what kind of tit tat back and forth debates are we going to see between President elect Trump, which we know isn't going to hold back, and the FOMC?
Right. Well, I think those are, you know, a lot to look at. You unpacked a lot. I think that what I really appreciate from you, Jose, is that you're really willing to, as I like to share with you, you are the one arm economist. You don't say on one hand this, on one hand that. You're very clear in what you expect. What I'm hearing from you is it's kind of steady as she goes. Don't think inflation is cured, because it's really not cured. I don't think it ever will be. My 2 cents is, if we continue to grow the economy, we're not going to eliminate the deficit. We have to bring that down. And any last thoughts that you want to share before we wrap it up? Anything I forgot to ask, or anything that's on your mind that you'd like to share?
Sure, we spoke a lot about, valuations and historically them being stretched, but the to the extent that we allow inflation to stay at around 3%, 3.2%, then valuations are fine where they are. They don't need to pull back. Valuations will pull back only if the Fed takes an apprehensive stance against the market. And as of now, that does not look like it's going to happen.
Right. And I would not expect it. Hey, let's wrap up by wishing you a great, happy, healthy new year. All the best in 25. Jose, we really appreciate also your articles you're contributing to the Pro Investor newsletter. And as always, I want to say, if there's something you see that sparks something important, reach out to us. We'll do a quick video, because it's really important to have a guy with your insights on the economy, the government, how they interact. It's really a pleasure to have you on.
Thank you so much. And everyone, check out our new forecast contracts with Interactive Brokers. Happy holidays, everyone.
All right, fantastic. We'll see you soon. One more time. Happy, healthy new year. Thanks for your time today, Jose.
Thank you. Bye.